Welcome back to the Prosperity Trading System with Dr. Butler, the MD Investor. This section is on candlesticks being made easy. When it comes to trading, it's very imperative to understand that these topics layer on top of each other. Not one individual topic or one individual subject is going to make you a successful trader, but understanding overall how these topics work together and stacking that knowledge will make it so that you're able to trade in any type of environment. And that is our goal. The topics that we're going to cover today is just a deeper dive into candlestick patterns. Reviewing candlestick anatomy from before, remember, bullish candles are candles that open on a lower basis and close on a higher basis. And the only difference between that and a bearish candle is a bearish candle opens on a higher basis and closes on a lower basis. The rest of the anatomy is exactly the same. Now, a review of candlestick chart patterns. Candlestick patterns can be either single, double, triple candlestick patterns. There are lots and lots and lots and lots of patterns. Now, what we want to focus on is the majority of the patterns. There are 8 very standard patterns that realign themselves over and over and over and over again. And instead of having to learn all of them, just learning 8 of these patterns and realizing that they are inverted when they take place will make life a lot easier. There's also what's called indecision or neutral candlestick patterns. These are either going to be a doji formation or a spinning top formation, where the wicks outweigh the candle body itself, and the candle typically sits right in the middle in terms of its body formation. Now, when we have bullish candlestick body patterns are usually candlestick patterns that show a reversal sign when the market is falling, followed by a particular style of candle. In this case, in a bullish pattern, this would be a hammer. The inverted portion of this would be a shooting star. Now, a shooting star is just this hammer turned upside down. Now, you notice this pattern also takes place twice. One is an inverted hammer. Now, you'll notice that the inverted hammer and the shooting star look exactly alike. However, they are not the inverse of one another. These are. An inverted hammer is also known as a hanging man if formed in a bearish pattern. These candlestick patterns show themselves over and over, and being able to recognize these at key locations will help you take your trading to the next level. It'll almost feel like you can start to predict what the market is going to do. Not because the market is predictable, but because patterns are predictable. And the reason why the patterns make the market more predictable or higher probability is because patterns start to show sentimental or mental retracement for a lot of different traders. When traders see a certain pattern, they react the same way. For example, whenever you see a red light, you tend to stop at a red light because that is cultural pattern and cultural sentiment. Most people do not see a red light and decide to floor it. Some people do. However, those usually result in accidents. In this case, if you're someone who pays attention to these patterns and you notice that the overall market sentiment matches these patterns, you can be more successful. Now, with a doji pattern, a doji is an indecision candle. However, when they're paired together with a reversal pattern, such as a dragonfly doji or its reversal, a gravestone doji, then it starts to make a lot more sense. A bullish engulfing is when the entire body of a bullish candle engulfs the body of a bearish candle, and vice versa is a bearish engulfing, which does the same thing. A piercing line is when the smaller body of a green candle starts to pierce more than 50% of the body of the initial downward bearish candle, and vice versa. If a green pattern candle was coming up and then more than 50% of that candle was absorbed by a red bearish candle, this is known as a dark cloud cover. These are the same formation of patterns. Same thing with a spinning top that forms at the bottom of a reversal pattern. This is known as a morning star because a morning star is where the star or the sun starts to rise, versus an evening star, which is when it forms, is when the sun starts to set or go down. Now, this exact same pattern is the same here with a morning doji star or an evening doji star. These patterns make it quite easy to see how repetition is something that you can capitalize on. Now, a continuation pattern is also known here as 3 strong pushing candles in one direction, known as 3 white soldiers if it's to the upside, or 3 black crows if it's to the downside. Here is an example. once we have on the SPY or SPF 500 in 2020, you notice that as the markets started to push up, there was a lack of decision, which means there are small body candles, smaller and smaller, also indicating lack of volume, followed by indecision, 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 with a confirmation candle pushing the market downwards. That continuation down happened until the full cycle was completed, followed by, now again, keep in mind that the color is irrelevant, but the formation is important. A candle where the wick starts to reject and the body closes up top. This is the formation of a hammer-like candle, and that forms and shows a reversal. So you can see that happening here, followed by the market being pushed up. And then you'll notice here an inverted hammer, followed by the market being pushed up. Followed by what we would have here is a hanging man and a shooting star next to each other, with the market pulling down. And you'll notice that this type of pattern happens over and over and over again. And seeing this kind of sentiment can help you understand where to enter and exit the market. The reason these candles are brought up are these are very particular candles known as Marubozu candles. In Japanese, Marubozu means shaven head, which means that these are candles that typically do not have a wick. Now, in some occasions, they might have small wicks or just a wick on one side, but 9 times out of 10, these are candles that form and cause large momentum. They're also known as elephant candles for some people. These are what you would call billion-dollar candles. This takes a lot of money to form and a lot of volume to form. 97% of all candles that happen within the stock market form wicks. That means some level of rejection or some place where price is moving in a predictable fashion. These are not predictable candles. And because of that, they are normally seen in places where institutions start to enter orders, which means you might see a very large green candle followed by a red candle that seems to match its size next to each other. This is usually an indication of institutional orders being entered. Here's an example of the difference between Marubozu candles, and if you notice and you go through the majority of these candles, you notice how mostly all of them have wicks, 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 wicks. Only a few, such as this candle, where they're not being printed, this would be a Marubozu candle. Same with this. This has a small wick to the upside, but for the most part, this is a Marubozu candle as well, where mostly the head of it is shaven. If you see these prints side by side, more than likely this is starting to be an area where institutional investors are entering the market. Now we'll revisit support and resistance. Now keep in mind with support and resistance are typically where in a downward trend, the market will tend to pause, find a level or a price where it respects that area, and it starts to create what's known as demand. Demand and support, sometimes used interchangeably, are not interchangeable words. Demand is when competition to buy is formed. And when competition to buy is formed, the market is pushed up drastically. Resistance, sometimes also known as an area of supply where it's created, is a price where it's respected above current price, and it usually has a rejection or a reversal of an upward trend. Again, this creates an area known as supply, and that area of supply, again, not interchangeable with the word resistance itself. It is an area where a competition to sell kicks in, and people are looking to exit their position or take profits. Now, in support and resistance, you'll notice that you have key indications such as this very large candle that is forming a huge wick and a doji candle. So this would be something like a dragonfly doji candle where price was swept and all the liquidity prior to this area was taken up by these orders and then used to push price higher. Now you'll notice how we have large candles printing next to each other, green and red, about the same exact size. This is typically where institutional levels start to form. When you see candles like this, back to back, relatively the same size, the larger these candles are, the higher the institutional entry point is. The smaller they are, it means that it usually took time for other institutions to start to match that area, which means that the move is not as great. The better the move is, is when you have two candles that form quickly back to each other. The more candles that form, the less institutional power there is. So you'll notice here, only two small candles are formed, but it's two small candles back to back creates buying pressure. Now you'll also notice here a shooting star all the way up to the area of resistance, which creates an area that's forcing the price to move down. But we go back into an area of support and we do this over and over again. This would be considered an area of consolidation. And then what's known as a breakout trade would be a trade that pushes above current resistance or breaks below current support. Some people are known as breakout traders, which are their favorite types of trade. Some people just trade within consolidation, which is being able to take this to the upside in a very short time fashion and doing this over and over, which means that you do not have to have a lot of stocks to trade. You can just be very good at a few small stocks and learn their positions, learn their patterns, and trade something very simple over and over and over again. Here's an example on a live chart. What chart we're trading is irrelevant because this can be anything from Bitcoin to XRP to the SP 500 to oil futures. It does not matter. The idea is the same. So now what we'll have here is a same similar pattern. And you'll notice this is a shooting star that is forming in an area of resistance, causing price to go down. Once that occurs, this is where you would exit your position. If you were someone who was trading from a zone position, this is where you would enter your short position. This is, again, you would be on a selling side. If you're an options trader or derivatives trader or commodities trader, this might be a position where you take a short, you take puts on, and you exit your position here. Now, this wouldn't necessarily be a position to enter. You could if you want, however, this is not a key level. And because of that, this is something you would wait on. And once you find that it retests your level and it gives you a deeper retest and a better shooting star with a confirmation, you would put your stop loss here, you would enter here, and you would take the position and get your full target. So now this would be one winning trade. This would be a winning trade with a complete full target. And from here, because this is now a key level, you would exit your position here from your shorts, and now you would enter a long position, and we would do the same thing over and over again, which is why you don't have to have many stocks. Here's an example, and this one is, again, the stock is irrelevant, but this is like crude oil if you trade the futures on a daily chart. And now what you would notice is an indecision candle, which also makes like a dragonfly doji. And now you'll notice that this indecision happened for 1, 2, 3, 4, 5, 6 days until it confirmed to the upside. So you had a doji candle, a spinning top candle, an inverted hammer, then you had another spinning top, and then another inverted doji hammer, and then now followed by a true hammer. Once this true hammer formed, it formed at a key level. So this was the initial key level of support. This formed a true hammer. Once the hammer formed and we had confirmation, this was to the upside. Your stop loss would be here. Your stop loss would have never been triggered. This would be your entry. You would have been down about 30% the first 2 or 3 days, followed by taking a profit at about 64% at the end of a week, depending on how you entered or when you wanted to enter. And if you did take this on a shorter time frame, say for example you're an options trader, this trade could have been entered on a Monday and exited on a Wednesday, and full profit could have been taken in a 3-to-1 trade very easily. Now, it's not whether or not you're right that's important, but how much money you make when you're right and how much money you lose when you're wrong. This is George Soros, famous for making over $1 billion in a single trade when he shorted the British pound. In this case, the goal is to make money by understanding the process, not by chasing money. If you chase money, you will fail, like many other traders before you. If you chase the process, you will be a successful trader, no matter the climate, no matter the market, no matter the turmoil. Fall in love with the process and understand that when it comes to losing money when you're wrong, it is better to cut as soon as humanly possible than to try to test and hope. I will see you guys in the next class.